Stocks our strategists feel are poised to deliver positive returns are featured now in their top stock picks of the week.
Hi, Shiraz Mian here with the Zacks top picks. Joining me this week will be David Bartosiak. Dave and I each have picked a stock. The stock I have picked is a defense contractor that experienced a spike, but I'll be positioning it as a quality, long-term strategic pick for your portfolio that adds to diversification and is very well positioned to bring you long-term capital gains. So this is the spike I was referencing. As you could see, after this quarterly result, the stock gained about a fifth of its value. What I've positioned it here is CACI, a defense contractor, about $14 billion in market cap, primarily and historically an IT contractor for the DoD and the intelligence agencies. So the green is the S&P 500, the red is the Zacks aerospace defense sector. This is the year-to-date performance, and this is the performance of CACI relative to the S&P and the aerospace over the last 5 years. So as you could see, there have been some ups and downs, but the stock has a history of outperformance. Given the nature of its business, its leverage to defense spending, intelligence spending, government spending, it's a lot more stable, it's a lot more visible, and the issues for its revenues and business is budget negotiations, defense outlays, these debt ceiling caps and the resulting effect on spending and what have you. But on the whole, this is a relatively low-risk business model, which is also reflected in its beta, which is about half of the market. So this is valuation. Most analysts covering the stock use enterprise to EBITDA, and that's what I've used here. Other conventional metrics like forward or trailing earnings mimic this. And this, as you could see, is a 5-year history. So it's at the high end of its 5-year range and has done a full-on spike over the last month or so, particularly post its earnings release. At the bottom, you could see a summary of this 5-year history, currently 14.1, high is 15.38, low 9.93. The median is about 12. So I'm sympathetic to the argument that the valuation level at present, particularly post the earnings release spike, there's no fundamental reason to be considering the stock. I disagree with that, and the reason for that is twofold. Number one, don't build your entire CACI position in one go. Start building it. Keep adding on continued weakness. And I'm not presenting and offering CACI as a tactical trading idea, but rather as a long-term strategic position in your portfolio that adds to your upside potential and also adds to diversification given the nature of its business. And all of that is a function of what I'm presenting as a transformation of the business. This is the estimate revisions. Those of you familiar with the ZAX framework, we put a lot of stock in the estimate revisions trajectory and framework, as we believe, for good fundamental reasons, that estimate revisions in one metric has the potential to tell you a host of fundamental evolution and developments that are tied to the business, that are tied to the economy, and that are tied to what's happening to the company as a whole. So summing it up, as I noted, this is a company in transition. And what I mean by that is that it's moving from its legacy low margin Department of Defense IT services business to more of a high margin product centric capability. Customer is still Department of Defense and the intelligence community. This transition that management has shared with the street over the last few years got a boost from the ARCA transaction earlier this year that filled some key strategic gaps in CACI's capabilities. The company historically has been a signal intelligence and electronic warfare services provider to its customers, and the ARCA acquisition as geospatial intelligence and ground-based processing and agentic AI capabilities. And it's the additional capabilities brought in by the ARCA acquisition that it's reasonable to credit that for why management raised guidance in its latest quarterly release, and why the long-term growth outlook for the business has fundamentally changed. Nothing is without risks. Obviously, the company used a fair amount of debt for this ARCA acquisition. This is about $2-3 billion acquisition. And obviously the Department of Defense and the federal budgeting exposure. But on the whole, this is a quality defense player that offers a fair amount of diversification to your portfolio. And if you build your positions on pullbacks, I believe this will be a long-term winner for most of you. With that, I'll pass it on to Dave.
All right, Shiraz. Well, thank you for that top stock pick of the week. I've got another one here. It is Corsair Gaming, ticker CRSR. And when I say gaming, I'm not talking about gambling or anything like that. We're talking about gaming peripherals. So they make like mice and keyboards. And oddly enough, the keyboard that I have right now, or the mouse that I have in my hand right now, is from Corsair. There is X rank number 2 buy. We have a B for value, A for growth, and C for momentum to help it round out with a VGM composite score of A. Now, they just had a nice earnings report. EPS came in 228% better than expectations. A big jump on that, which is great. Now, what I want to show you here is that this year is kind of like a throwaway year if you look on the sales side, but not so much when it comes to earnings. So current year sales expected to come in at $1.45 billion. That's a small contraction from last year. Next year, they're expecting a return to that growth, 5.87% growth next year to $1.53 billion. Honestly, a part of this is because these RAM prices are so expensive. Those folks that normally would go out and build themselves another computer this year are kind of holding off, hoping that some of the components get a little bit cheaper before they do. And if you're going to customize your rig with all types of new shiny mice and keyboards and such, you're going to wait a little bit. Honestly, I'm in that same boat. But if you look over at the earnings side, this is when it gets really good. So we have that 17% growth for the current year, getting up to 73 cents per share. Next year, you got another little bit of growth up to 74 cents. But that number's been up recently. Over the course of the last 30 days, really, just since the company reported, you have an analyst up in the ante for the current year, next quarter, and the current quarter. That's pushed up our Zacks consensus estimate for the current year from 71 cents to 73, and next year up from 73 to 74. Now, look at this nice surprise. We've got 23 cents EPS for the quarter when analysts were really only looking for 7. That's on the heels of last quarter where they did the same thing. They came in at 27 cents versus expectations calling for 18. So management's doing a reasonable job of helping to curtail these expectations of analysts, and then they're delivering to the upside, which is great. You can see that a lot better here on our price consensus and EPS surprise chart. My favorite chart by far at Zacks. The left y-axis here is EPS. The right y-axis is the stock's price. These green arrows are earnings beats, in this case, some big earnings beats, and the red arrows are earnings misses. These multicolored lines represent the evolution of our Zacks consensus estimates over time. And you can see there's no wonder why this stock was under pressure, because earnings were under pressure. So whenever you get this situation where you're going to over promise and then under deliver, the stock usually takes a tumble. And that's exactly what you saw in Corsair. You see here throughout 2024 and 2025, things going to the downside. But recently, we've seen a little uptick, and this is where we're seeing the growth. But also, notice how this number, and this is, in this case, this is the 2026 EPS number, getting higher throughout the course of this year. Next year's number ticking up, but 2028 is really when we're starting to get some momentum, and that's helped the stock go from the doldrums, $5 holler, all the way back up here into the teens, but it still has a long way to go. If you go back to the highs of 2021, this thing was close to $30. So if these earnings can continue to tick on to the upside, if management can keep delivering on those promises, I think you're going to see this stock continue to rally, and it could be another one of those turnaround stories. I think the market's looking for these turnaround stories because there's been so many stocks that have just been so red hot that sort of popped. I would argue we've had a little bit of a bubble that has popped in the AI stocks, namely the Nebiuses of the world and the Microns and the SanDisks and so on and so forth. But investors are looking for these other plays where they can make some money, where earnings are starting to turn around. And I think Corsair could be one of those to keep on your radar. Of course, we had it in Surprise Traders, so we benefited from that nice little pop. Had to brag about that. All right, folks, that's all I got for you now. So for Shiraz and I and everybody else here at Zacks, we want to say thank you for checking it out. But before you go, be sure to check out Zacks.com/promo for this week's awesome deal here at Zacks. Thank you again, and we will see you next week.